Today, I can sum up the outlook in only 14 words. I like this. The Fed is solving for 2% inflation. The market is solving for the Fed. Is this market entirely looking to the Fed, and a day like today is just betting the Fed will not have to raise rates as high and keep them there as long?
I think that's true, and I think the market is feeling more confident, if you will, that it can look past peak Fed, whether that's 5% or 5.25% or 4.75%, and onto a more neutral kind of zone that will presumably come after the peak, which will be early next year, and then towards 2024. So if that neutral zone is 3.5, and you put in the math of where the 2-year yield is, where 10-year real yields are, you plug that into a discounted cash flow model, you get to the kind of levels that we're now seeing in the market. So I think the CPI and now the PPI reports give the market some confidence that finally we can look past this peak in the curve and onto a more sort of normal range of interest rates. And that's how you get from 14 or 15 times earnings, which was really kind of the fair value when the 2-year yield was at 4.7 instead of now in the low 4s, and onto a 17 type of multiple. Whether we can get beyond that, of course, is the big question.
Are markets overly rosy right now?
I don't think they're overly rosy, but that doesn't mean they have a lot more room to rally from here, because at a 17 multiple, which is kind of where we are now, and that's assuming that earnings, of course, hold, which, of course, is a very big assumption. I think we've already discounted a return to some kind of normalcy in interest rates. So in order to get another leg up from here, I think there would have to be more visibility that earnings are not going to fall, and then the market can have some comfort in the denominator of the PE. But also the Fed might start to throw cold water on this rally, because what happens when stocks rally and bonds rally and the dollar goes down? Financial conditions loosen, which is the opposite of what the Fed wants to see during a tightening campaign, because it wants financial conditions to tighten. So another risk is that the Fed will start throwing cold water on this rally.
How much do you have to look to big tech? And I keep coming back to this because it's such a significant component of the overall indexes. If there isn't something more structural about how they operate that gives people confidence, can we see the S&P end up positive next year versus where we are today?
It's possible, but the what I call the Nifty 50, the big mega cap growth stocks, those have been a powerful engine for the markets over the past 10 years or so, right? They generate a lot of free cash flow. A lot of that cash flow that was extra was returned back to shareholders via share buybacks. And that financial engineering machine has been very, very rewarding for investors, because it creates a high payout ratio, right? More earnings are returned to shareholders directly via dividends or indirectly via buybacks. But clearly there's been pressure on those mega cap growth names. We've seen that this year. Most of them are down significantly, and they rely on a very low cost of capital in order to compound that very long duration stream of cash flows. So it's a big open question as to whether that can continue, and the rotation we're now seeing, right, towards value, towards small caps even, that could have some legs.
How hard was it to come up with a 2023 outlook?
It's hard because there are so many moving targets, but really right now it is about the Fed. The Fed has made it clear that it's not just inflation coming down that they're after, but they want inflation back to 2%, or 2% tends to be on the core PCE that they look at mostly, so that's about 2.5 on the CPI, and we're still at around 8%. So from 8 to 2.5 is going to take some time. It might happen fast in terms of getting from 8 to 4. I think that part will be relatively easy, as your previous guest indicated, just from base effects, but it has to go all the way to 2 for the Fed to be able to truly step off the brakes and allow for a neutral policy. And that's a question for the back end of this cycle, a year from now or 6 months from now, and it'll be the biggest variable for 2023.
If it's all about the Fed, What's your biggest conviction, considering that there's a lot of uncertainty right now around the Fed?
My biggest conviction has evolved because a year ago, I would have said, and I did say, that the Fed has a dual mandate: full employment, price stability, 2% inflation. And I said that if inflation goes to only 3, let's say, inflation back then wasn't at 8 yet, while the economy was going into a recession, I said the Fed would kind of tolerate above target inflation in order to keep employment, at full capacity. From what I'm hearing and seeing, and from talking to former Fed officials, the Fed is going to sacrifice the economy if it needs to in order to get inflation not just down from where it is, but all the way down to 2. So I think a Fed that is maybe more hawkish than we've all kind of come to think over the last few years after all the monetary stimulus we got during COVID, I think is probably one of the highest convictions themes out there right now.
Just quickly, what does that mean for markets? What does that mean?
It keeps a lid on valuations. Earnings are holding up, although that's mostly in nominal terms, right? So there's a money illusion from inflation. And when you go back historically, you see inflationary recessions. Earnings tend to hold up okay, but it puts a ceiling on how far the PE can go. And whether it's 17 or 18, I don't know, but there is a limit to that.
And we're getting close to that limit.
Yes, I think so.
Jurrien Timmer, thank you so much for taking